A stunning 84.6% gross margin for a hardware manufacturer, yet Wall Street seems entirely oblivious to the underlying fragility of this windfall. SanDisk just delivered a masterclass in financial performance. But are these numbers a permanent structural shift or a cyclical peak about to normalize? Q4 revenue surged to $8.97 billion, delivering incredible 372% year-over-year revenue growth. How did a legacy storage provider scale so quickly? Headlines are screaming about the AI revolution, assuming the firm is riding a broad hardware wave. But when you look at the data center segment revenue growth, which skyrocketed 437% year over year, the real story emerges. Management isn't just selling to anyone. They are aggressively targeting hyperscalers building massive physical infrastructure, like the giant server farms required to run complex AI workloads. This is a profound shift toward the highest value buyers, securing the company a critical seat at the infrastructure table. But to grasp why this is happening, we must look at something seemingly unrelated. Q4 gross margin landed at an eye-watering 84.6%, representing a massive 58.4 percentage point gross margin expansion from the prior year. At first glance, the consensus view is that SanDisk has unlocked the ultimate operational moat, achieving software-like profitability. However, management noted that 66% of the sequential top-line acceleration was driven by higher product pricing, not just moving more physical units. This reveals a critical structural reality. If semiconductor memory prices revert to historical averages, the business faces severe margin compression, even if data center volume remains robust. And this brings us to the real elephant in the room regarding profitability. The headline Q4 GAAP net income hit $6.9 billion, translating to a diluted earnings per share of $43.97. Most analysts are entirely captivated by this flawless bottom-line print. Dig slightly deeper, and you find a one-time $804 million non-operating net gain on equity securities, artificially inflating that figure. Institutional investors will strip this out to assess the true operational health of the company. Retail expectations anchored strictly to that headline earnings per share might be pricing in a level of perfection that the underlying operations simply cannot sustain indefinitely. Yet the cash generation engine inside the firm remains fundamentally formidable. For the fiscal year, free cash flow reached a monumental $11.49 billion. How does a capital-intensive hardware business generate this level of supreme cash conversion? Many retail traders are purely focused on the sheer size of the yield. However, the firm generated $2.48 billion of this operating cash flow through new business model prepayments and upfront deposits. The company is collecting cash right now for storage architecture that still needs to be delivered later. This front-loaded cushion is a brilliant liquidity play by management, but it risks creating an air pocket in future periods. So, what do you do with that kind of front-loaded windfall? The firm authorized a massive $15.5 billion share repurchase program. They already executed $4.52 billion in share buybacks over the past fiscal year, drastically shrinking the available public float. Day traders assume this is just standard corporate engineering to boost per-share metrics. In reality, management weaponizing this massive $11.49 billion free cash flow establishes a formidable mechanical flaw under the stock. By continuously soaking up outstanding shares, the business signals profound confidence in its intrinsic valuation, actively protecting its equity base from broader market volatility. To understand the true brilliance of this capital allocation, you must look at the balance sheet liabilities. In a single year, total debt was reduced from $1.85 billion down to absolutely zero. The firm now boasts a pristine zero debt-to-equity ratio. Why does eliminating leverage matter so much right now? Some folks think a zero-debt balance sheet just looks like conservative accounting. By systematically removing all debt servicing costs in a highly uncertain rate environment, the company ensures every incremental dollar of operating profit flows directly into shareholder equity. But before we crown this a perfect balance sheet, there is a glaring mismatch we absolutely cannot ignore. Accounts receivable growth skyrocketed by 340% year over year, pushing the total accounts receivable balance to an astonishing $4.71 billion. How does a company collect so much cash upfront via deposits while simultaneously letting its unpaid invoices explode? Financial commentators rarely check working capital dynamics when top-line growth is this fast. Yet, this receivables build-up significantly outpaces the 175% annual revenue growth rate. If SanDisk fails to efficiently convert these receivables into cash, it could signal underlying liquidity strain among its core customers. This working capital tension makes the fundamental outlook for the upcoming quarter absolutely vital. Management issued Q1 revenue guidance between $10.3 billion and $10.8 billion. They also projected a non-GAAP gross margin guidance range of 83% to 85%. The broader public assumes this elevated pricing power is the new normal, effectively ignoring cyclical history. By publicly setting this bar, the firm is promising that the current structural demand dynamics will hold steady. If they miss these heavily elevated targets, the market's repricing of the business will be incredibly swift and severe. To defend these lofty targets, the company is actively attempting to rewrite the fundamental rules of its industry. SanDisk is systematically shifting away from short-term procurement cycles by executing 10 new business model agreements with its largest clients. Can this notoriously volatile hardware sector actually become predictable? Most casual observers treat semiconductor cyclicality as a 100% inescapable law of financial gravity. By locking global hyperscalers into long-term hardware commitments, management is trying to permanently dampen that historic revenue volatility. If this structural transition holds, the business could warrant a significant multiple expansion as highly visible earnings replace boom and bust uncertainty. Finally, securing those long-term contracts requires absolute technological dominance, which leads us to their latest strategic maneuver. The firm spent $348 million on research and development in Q4 alone, co-developing a new high-bandwidth flash technical specification with SK Hynix. Why partner with a peer on an open architecture standard? Pessimists often view joint ventures as an admission of weakness. However, by taping out the first memory die for this open compute project, the company embeds its technology at the foundational level of next-generation AI inference hardware. This move builds a defensive technical moat, ensuring the business remains the indispensable vendor for data center architecture. Ultimately, the business is a formidable compounding machine, but it lacks a margin of safety today. But I want to hear your take on whether these elite margins are actually sustainable. Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.